Okay, let's dive into this. Welcome back to another explainer. Today, we're putting on our value investing hats and conducting a rigorous, Buffett-style financial autopsy on a company you definitely know, but maybe haven't analyzed through the strict lens of a capital allocator. We're talking about Allstate, ticker symbol ALL. We're going to completely strip away the daily market noise and look purely at what the underlying cash flows and metrics are telling us about the true intrinsic value of this insurance giant. I want to start by throwing a number right at you. $687.86. According to the discounted cash flow metrics in our source data, this is the calculated intrinsic fair value of Allstate stock, based purely on its free cash flow generation. It's an absolutely staggering figure, especially when we look at the reality of Mr. Market today.
$215.54. That's the current closing price. So we have a calculated fair value north of $680 and a market price sitting comfortably under $220. This massive discrepancy is the central mystery we're unpacking in today's explainer. Is the market missing something entirely, or is there a fundamental catch buried in the numbers? To solve this, here's our roadmap. First, Allstate at a glance. Second, profitability and growth. Third, dividends and financial health. Fourth, valuation and fair price. And finally, the ultimate takeaway.
So, Section 1, Allstate at a glance. Let's take the 30,000-foot view. Just skimming the surface-level metrics, we're obviously looking at a massive established player. Allstate boasts a market cap of over $55 billion. At roughly $215, it's trading near its 52-week high, yet the year-to-date return is a kind of muted 4%. At first glance, you might think the market is treating this like a slow-moving, mature stalwart. But as any seasoned value analyst knows, the surface rarely reveals the true economic engine underneath.
Moving right into Section 2, profitability and growth engines. It is time to dig into the vital organs and see if the underlying business actually justifies that massive fair value calculation.
To do that, we have to look at a metric that the greatest value investors literally obsess over: return on invested capital, or ROIC. Simply put, this measures how efficiently management takes the cash it has and turns it into more cash. A high ROIC is the absolute hallmark of a true wealth compounding machine. And the shift happening inside Allstate right now is explosive. Just look at this. The 3-year average ROIC was a pretty sluggish 2.08%, but the current ROIC, it's sitting at 7.88%. That is a 279% improvement in capital efficiency. Management is deploying their cash much more effectively today than they were in the recent past. We're seeing this exact same narrative play out in the profit margins. The 3-year average net profit margin was just 3.5%. Today, it's almost 10%. That's a massive 323% increase over its historical average. This tells a story of a business that isn't just bringing in revenue, but is squeezing drastically more profit out of every single dollar that enters the door. They are firing on all cylinders.
Now, what's really interesting here is the sheer velocity of these growth metrics. Looking at the trailing 12-month compound annual growth rates, net income is up 123%, earnings per share is up 103%, and their free cash flow, what Warren Buffett would refer to as true owner earnings, has grown at a 28% compound rate over the last 3 years. These are certainly not the numbers you typically associate with a mature, sleepy insurance company.
Let's translate that into actual dollars. Allstate brought in an enormous $67.68 billion in trailing revenue. But what truly matters is cash conversion. They generated over $10 billion in net income and an incredibly strong $9.88 billion in free cash flow. Because those net income and free cash flow numbers are nearly identical, it proves their earnings are remarkably high quality. There are no accounting illusions happening here. This is cold, hard cash. Section 3, Dividends and Financial Health. Let's check the immune system. Because a company can grow all at once, but if its balance sheet is fragile, it's a completely uninvestable cigar butt. The ultimate gauge of risk here is a pristine debt-to-equity ratio of just 0.24, meaning for every single dollar of equity, the company holds barely 24 cents of debt. Furthermore, this ratio is 40% lower than its 3-year average, which tells us management is actively deleveraging. It is an incredibly secure, fortress-like balance sheet. Because they generate so much free cash flow and carry so little debt, their capital allocation is phenomenally secure. They pay out just 10.51% of their earnings to shareholders as dividends. That means nearly 90% of their earnings are retained to aggressively reinvest in the business, buy back stock, or weather any potential economic storms.
And even with that highly conservative payout ratio, they still offer a respectable 2% dividend yield, backed by an established 15-year track record of consecutive yearly increases. You're getting a growing yield that is virtually bulletproof based on their current cash flows.
All right, Section 4, Valuation and Fair Price. The Value Investor's Diagnosis. How on earth is the market pricing all of this fundamental strength?
Before we look at the multiples, let's ground ourselves in Ben Graham's ultimate value investing concept, the margin of safety. The goal isn't just to buy a wonderful business, it's to buy it at a significant discount to its true intrinsic value. That discount is your absolute cushion against unforeseen errors or wild market downturns. Keeping that margin of safety in mind, listen to these current valuation multiples. A price-to-earnings ratio of 5.65, a price-to-free cash flow ratio of 5.78, an enterprise value-to-EBITDA ratio under 5, and perhaps most shockingly, a PEG ratio, which measures price and earnings relative to growth, of practically 0.05. These are historically, staggeringly low multiples for a company gushing nearly $10 billion in free cash flow. Isolating just the PE ratio, it sits at 5.65 right now. Compared to its own trailing 12-month average of 7.76, the stock is currently trading at a 27% discount relative to its own very recent past. The market is pricing Allstate as if its earnings are about to permanently fall off a cliff, completely ignoring the triple-digit growth metrics we just verified in the filings. Which brings us right back to our ultimate valuation models. Using a rigorous discounted cash flow analysis, if you calculate intrinsic value using their massive free cash flow base, you arrive at that astounding $687.86 per share, and even if you use the more conservative earnings per share base, the fair value is still calculated at $340.21. Both of these models absolutely dwarf the current $215 market price.
Section 5. The final takeaway. Our ultimate diagnosis.
When we anchor back to the free cash flow valuation, the data calculates a staggering 68.67% margin of safety. Think about that. Mathematically, the stock would have to nearly triple just to reach what the cash flows dictate the business is inherently worth today. Which leaves us with this final thought. You have a company with a 15-year dividend growth streak, a fortress balance sheet, a surging return on invested capital, and a calculated 68% margin of safety based on pure owner earnings cash generation. So I leave you with this. Is there some massive, hidden structural risk we aren't seeing on the balance sheet? Or is Mr. Market simply experiencing a drastic, irrational mispricing of Allstate right now? That is the exact question you need to answer in your own research. Thanks for joining me on this explainer, and we'll see you next time.